Welcome, everybody. This is the second in a series of interviews that I'm doing to try to understand why food prices are rising and might get worse. And we've talked about some of the supply shortages and dynamics, but today we're going to talk about the money supply. And I have with us Dr. Michael Howell, who has a PhD in economics, and he specializes in analyzing global central bank activity. He's the founder and CEO of CrossBorder Capital. Welcome, Dr. Michael Howell. Thank you so much for coming on.
Good pleasure, Chris. Thank you.
So could you, I guess, start us out by, my audience is not, some of my audience will know finance, but many of us won't. Could you kind of give us an introduction to the basics of the money supply? Like in our economy, how is money created, and how do you measure that from different measures of the money supply and liquidity and stuff like that?
Okay, well, it's a complex and it's a fairly wonkish subject. So let me try and give a sort of straightforward view of what goes on. Basically, money, as people tend to think of it, is, let's say, something you have in your bank account or in your wallet or basically behind your credit card. And it's for most people, it's essentially a means of transaction. What we're looking at is a much broader concept of that. We're looking at, if you like, all forms of money. And we take that in a very, very, very broad sense of basically looking at what we call not just retail money, which is what most people would understand as money, but actually wholesale money as well, which is essentially money creation that occurs within or by big financial institutions, probably outside of high street banks. So this is the very broad or wide financial sector, and it extends not just along the shores of America, but internationally. It's a global concept. So we're looking at the amount of liquidity or money creation that occurs in the US, in Europe, in China, Japan, etc. In actual fact, we monitor about 80 to 90 central banks worldwide to try and get a sort of comprehensive grip on this. Now, the key thing really to understand is the transmission of money. And basically what we've seen in the last 2 years or so, actually within the last 2 years, is a phenomenal increase in the amount of money that's been created. I think off the top of my head, the statistic for America is that M2 money, which is basically money in wallets and in bank deposit accounts, essentially has increased, or 42% of the total stock ever of money created was created in the last 18 months. I mean, just think about that. There's a huge, huge expansion. And basically politicians or policymakers have bailed the world out of the COVID crisis, and maybe now for the Ukraine-Russia crisis, by basically opening the money taps. So it's a complex subject, but it's essentially the means by which people transact. And we take a very broad view of looking not just at retail transactions, but wholesale transactions, which also include asset markets.
All right. So could you walk us through, when a new dollar, so 42% increase in the money supply, who's making that money? Is it the Federal Reserve or is it the banks? And what is, if a new dollar is created, what does its life look like by the time it gets into the hand of a consumer who's buying something with it?
Okay. Well, I'll let you into a secret here. The true answer is that nobody really knows. Okay.
Oh.
You can textbooks, economic textbooks, and they give you an answer. That happens not to be the correct answer, but it's actually a convenient narrative, because it basically says that the way that money is created is that it's created ultimately by the central bank increasing the reserves that commercial banks will hold. Commercial banks can then lend that money. That money then comes back to the banking system as a deposit, and it's the deposit that's chalked up as effectively money supply. Now, that's a very neat model. Doesn't kind of work like that in practice. But in practice, what happens is that the onus is very much on the banks. And let me extend that again in concept to all financial institutions that can create credit. They're the ones that actually make loans. And it's that decision to make a loan that's really the critical thing in terms of generating money. Now, the other conduit that is important in this dimension, which is also a source of lending, is the central banks themselves. And the central banks, particularly in the last um, 18 months, but I think one can even extend going right back to the Lehman Brothers crisis in 2008, central banks have taken a much, much firmer grip on the creation of credit and hence money in the US and more broadly in the world economy. So if you look back to the culprit who has actually done this, where are the fingerprints? It's really with the central banks, the Federal Reserve, the Bank of England, the European Central Bank, etc. They're the ones that have effectively started this process. And the way they've done it in practice rather than in textbook terms is they've basically made it easier for financial institutions to borrow in the markets. And as those financial institutions borrow or get what is called funding, they can then use that funding to lend to you or I in the markets.
You mentioned banks and other institutions that lend. Could you give an example or two of non-bank institutions that create credit?
Credit cards would be a good example of that. It could be revolving credit such as car loans or other forms of credit. It could be mortgage banks. It could be in the US the GSEs, for example, government-sponsored enterprises, Fannie Mae, Freddie Mac, etc. They could be sources of lending. You could effectively securitize, which is a way that lending occurs. In other words, rather than actually making a loan, you discount a security. So a corporation will come to a bank or a financial institution with a piece of paper, a security, and effectively that is discounted, in other words, bought by the financial institution, and effectively money changes hands. So these are all different routes. The reason I stress the wholesale dimension of money is it's that security element which has really ballooned in the last decade or so. So it's things like what are called wonkishly repo transactions, which are sale and repo operations, where basically a corporation will maybe issue a security and then guarantee to buy it back at some stage in the future, but that will be a short-term loan. So don't just think of a loan of going to a bank and writing a contract out. Most lending, probably the bulk of lending today, is in some sort of securitized form.
And so that's basically lending that's going to corporations and back.
Yeah, or money market funds or whatever. Effectively, it's let's say non-retail, so it's corporate or financial institutions.
Right. You brought up that central banks have taken, if I understood it correctly, central banks have taken greater control over basically issuing the money. Did I understand that right?
Correct.
And the reason that I'm asking is because I was reading a blog about the great financial crisis a few days ago, and this was someone who worked in the industry at that time, and they were making the argument that central banks didn't really create a bunch of money when they stepped in to solve that crisis, but rather since like 1997 or 1998, the banks had created all this money money or debt, whatever, credit that got wound up in those mortgage-backed securities. And that was the great expansion of the money supply. And then the Fed stepped in to buy those assets and essentially acted as the insurance for them to create an irresponsible amount of debt. And so when he showed the graph of the central bank total assets and the central bank mortgage-backed security assets basically going up at the same time, like in solution to the crisis. And he didn't show the money supply, but I went back and looked at the M2 money supply, and it looked like it was backing up what he said, because it looked like there was an inflection point in the late 90s, and that it reflected that the banks were the ones who made that money, and then the central bank came in and bailed them out. But if I understand what you're saying, is now the world has changed a little bit, where the central bank is saying, no, we're taking control of issuing the credit now. What do you think of that? And then am I understanding you correctly when I say that back to you like that?
Yeah, I mean, all those points in truth are absolutely correct. And it's just a question of maybe answering the question of how money gets in the system or how money is created. And as I said, it's a kind of a gray area. in many ways. But I think there are two examples I think one can raise. I mean, one is if you look at the Lehman crisis in 2008, the so-called global financial crisis, or even previous ones such as the 1998 with long-term capital, etc. There's been, as we know, there's been a whole sort of parade of these things over the years, but they all really come back to fundamentally the same kind of question, and that is that what you get is the private sector ultimately is creating credit, okay, and that credit system is backstopped by the central banks, or hopefully backstopped by the central banks. And the difference between the types of money they create is that the private sector creates a form of credit, but that credit isn't necessarily acceptable, okay, if I'm making sense or you're following. And in other words, it could default. It's basically not spendable, but it's a form of credit. Now, if the central banks bail out those finance institutions, the only thing the central bank has got effectively to play with is let's say crudely US dollar bills in the case of the Federal Reserve. So it will actually cover those losses with its paper, which is US dollar bills. So happens that's legal tender in America, right, or used worldwide. So if the Federal Reserve comes in to bail out a finance institution, it's actually it's replacing bad money, if you like, with their good money. And every financial crisis has involved the Federal Reserve coming in and bailing the system out in some form. Now, if they didn't bail the system out, money would collapse in that sense. The supply of money would collapse because credit would disappear and banks would default and whatever it may be. But the guarantee we live with, in the West at least, is that the central banks backstop the system. And effectively, to think of it maybe another way, which, at times with these things, you need a wet towel around your head to think about the concept. But basically, if you think of different US banks, now, if you look at a Citibank dollar or a JP Morgan dollar, they basically trade one for one. Now, in a non-backstop banking system, they would not. So if you think back to the banking system back in the 19th century in the US, different banks would issue bills, but they wouldn't necessarily trade at par with each other. The very fact that the Federal Reserve is backstopping it means that a JP Morgan dollar exchanges for a Citibank dollar, exchanges for a Federal Reserve dollar. They're all equivalent, right?
Right.
The way the system works.
Yeah.
So that's one source. When you're getting to the specifics of the COVID crisis, there were various other conduits how money got into the system. One was obviously through government checks. The federal government was writing checks. Those went directly into people's bank accounts, although the federal government was basically selling debt and the Federal Reserve was buying that debt. So it was slightly convoluted, but it was effectively the same sort of mechanism that I described earlier on. So I think you've got to look at the specifics. But again, this is sort of fairly wonkish accounting to go into these various elements. But at the end of the day, what matters is this growth of global liquidity. And it's basically the most important thing, for all of us, basically. This is what determines the tempo of economies and asset markets and house prices and food prices and all these sort of things, ultimately.
Yeah. So in the COVID crisis, and I want to come back to the basic concepts in a minute, but in the COVID crisis when I looked up like the federal deficit and the asset, the central bank balance sheet, it looked like the increase was roughly similar in trillions of dollars. But was the central bank literally buying all the newly issued debt from the government, or was it just like in sort of manipulating the market to incentivize other people to buy that debt?
Well, okay, there's a subtlety here, is that the Federal Reserve, as I recall, is not allowed to buy newly issued debt. So
that's what I thought, yeah.
It can only buy seasoned debt. So in other words, it can only go into markets. Is there a difference in that? Well, I don't really know. It's just basically semantics. But that's technically what they do. So they're basically bidding in the markets for effectively off the run treasuries.
All right, that makes a lot of sense. All right, so it's illegal in principle, but in practice, there's a very good loophole.
Backdoor way of doing it.
Yeah. All right, so could you walk us through like a newly created? So obviously, in the COVID crisis, we have this fiscal response of the government that but with the Federal Reserve helping buy the debt that they issue, they are now able to generate all this debt and just hand it out to people as a means of helping either the individual or the businesses who had applied for the various help that was available. And so, obviously a dollar that goes directly into my hands, I can go buy food with it. And so obviously I see how that makes into the food system. In normal times when we don't have this fiscal response, how would newly created money ultimately wind up increasing the price of food? Would you expect it to lead to more economic activity by a corporation who gets a loan and then eventually it trickles down and then it finds its way into the food store? Or what is the right way to see that?
Okay, well, I think you've got to distinguish various elements, which again, sort of economic speak, but you've got to think about effectively whether inflation is being caused by the demand side or the supply side. So in other words, is it demand-led inflation, which may well be a monetary phenomenon, or is it some form of cost-push because there's been disruption to supply chains, or is it some hybrid of the two? And the second point to say is that money can be created, and the concepts that we look at, which is sort of a global liquidity concept, you can get these surges in global liquidity. It doesn't necessarily go into the real economy. It could just be essentially lodged in the financial system, and it can play around with asset markets and asset prices, including house prices and whatever. But it doesn't really do an awful lot it doesn't spill over to a large extent into the real economy. And therefore, you could argue that food prices are relatively less disrupted. Now, the difference with this recent surge in liquidity is it's been forced into the real economy by the fiscal authorities, by the US Treasury, because the US Treasury has actually made sure that people's bank accounts go up because they want to support incomes. There have been encouragement for banks to lend to businesses. That's certainly been the case in Europe, where there's been incentives for banks to make those loans, etc. So there's what they've deliberately done, the authorities have deliberately done this time, in a way they didn't do in the 2008 crisis or in previous crises, is, if you like, force feed the economy with that liquidity. Previously, it was almost totally flowing around the financial system. Now, that particular surge in liquidity that went into the real economy has certainly led to some increases in inflation. What was unclear at the time, and I'm saying at the time, going back, let's say 6 months prior to the Ukraine-Russia problem, is whether that demand surge was a relative price move because of disruptions in certain areas of the economy, or an absolute price move. And I think the consensus was it was maybe a little bit of a mixture. No one was really sure about that. I think the informed opinion now is it's very clearly a general rise in prices that we're getting, and it's probably largely coming back to factors like the Federal Reserve's largesse in terms of expanding liquidity. Now, clearly, on top of that, you've got a further factor which is now coming into play, which is the Ukraine-Russia effect, which is clearly bolstering energy prices or boosting energy prices and food prices, etc., and certain chemicals. And that's something which I think one's got to, obviously wrap in the same way as these other price rises, but it's really a different force.
Yeah. Well, if I look at the food CPI over time, and maybe I'll just try to show it on the screen here. Looks like I have a screen sharing problem. Never mind. So if I look at the food CPI, it looks like it's sort of, in 1971 or whatever it is, in mid 1970s, it hits an inflection point where it just sort of goes up at a 45-degree angle from a previous much smaller increase. And then if we zoom in, like in maybe sometime in like February or March 2021 or so, we get this other inflection point where it starts increasing again. So even if we go back to like these these times, like pre-COVID, there's still this like general increase in the price of food that is that's being, I don't know, is that being driven by the increased money supply, and is that a very indirect effect, because we didn't have these handouts the whole time, right?
Right.
So is I guess one thing I'm a little confused about is from the point of view of like demand for food, it seems that like hunger is physiologically regulated and therefore not very elastic. Like I don't get more hungry because I have more money. But but and then I guess like design, but and then also like this, we've been in a general state of abundance, right? And so if I can go to the store and get whatever I want and completely satisfy my hunger, why would more money push the price of food up? Although it seems like if there are supply bottlenecks where like since COVID, we've not had that general state of abundance at the store. So now it really feels like if I have more money and more willingness to buy what I want, and I think it's going to be in short supply, and I see it at the store, I might, because I have more money, bid the price of that up because I'm going to take it all off the shelves. And I do find myself doing that sometimes. Like sometimes I go to the store and I'm like, wow, that's in now. I haven't seen that forever. I'm going to buy everything on the shelf. So I kind of get that in a supply bottleneck kind of situation, more money going to me does make me bid the price of food up. But what, pre-COVID, what was it responsible for that general increase? Is it the money supply leaking through to consumer hands, or is it something else?
Well, I think you've partly answered your question by saying that there is an element, if people have more money, they'll spend that. But then I think you've got to look more broadly at the input costs for food. So what are the basic input costs? Labor and energy, right? Ultimately, that's what it comes down to. And those are affected, they are affected by essential general demand and monetary phenomenon. So if you expanded liquidity or money aggressively, you'd see a lot more economic activity. That would then start to create higher shortages, higher wages. There'll be arbitrage between workers in the food industry and workers in the automobile industry. If the automobile industry was getting increased demand and workers were getting higher wages, there'd be essentially bids for workers in the food industry to go and work in car plants. You get the idea. And the same with oil prices. Oil prices can be used for a number of things. They can be used for luxury travel. If they're being used for luxury travel, then the cost is going to go up and that will affect food. So I think there's a chain of phenomenon that clearly come in here. It's a much broader picture. And it may not be that food is the trigger, but there are cases when it is. Now, I think if you go back to the early 1970s, which is the example you drew, it's a very relevant one right now. For the simple reason that I'm old enough to remember. I mean, I was at school in the early 70s, and I remember quite distinctly kind of what happened. And basically, what you saw was initially a period of excess demand. A lot of countries did kind of what they've done now. There were different reasons. We didn't have a COVID crisis or whatever, but there was a general expansion of government around the late 1960s, really across the West. Remember in the US, Johnson's Great Society program, a lot of spending went through. That wasn't only the US, that occurred really in Europe too. And what you saw was a demand-led inflation, which started to push prices up. Now, that particular process led to bottlenecks and supply problems. And it was that supply shock, as I distinctly remember, that created specific shortages in a certain whole range of commodities, beginning with oil, although that was largely thanks to OPEC's decision. But you also got sugar shortages, you've got coffee shortages, and the price skyrocketed. I mean, if you want an anecdote, I can remember, as a student traveling to Switzerland and getting a telephone call from my host to say, when you come out, bring as much coffee as you can, right? This was 1974, because we can't get any, right? That's Switzerland. I mean, crazy. But that was the truth. And that sort of thing happened. Now, what we're seeing today is not dissimilar because supply chains are broken. Supply chains were probably shorter then, certainly compared with today. That makes today's problem maybe potentially bigger because there are more breaks in the chain that you can have. And I think if you go back to this whole problem of Russia and Ukraine, you've got to think to the extent to which those economies have been previously integrated into the West's production system. Now, I picked up a statistic, which somehow I remember, which is that Ukraine and Russia together produce a combined 12% of the world's calorie intake. Now, that's quite a thought, right? They're producing something like a 25 to 30% of world wheat production. They produce a much higher percentage of world fertilizer supply. All these things are important, apart from the fact, as we know, Russia's producing 25% of world oil, and it produces, 50% of European gas. I mean, these are big numbers.
Yeah, and they're all piled onto like pre-existing supply problems. One of my my last interview that I did was about the supply shortages of oil and fertilizer, and I was talking to a couple people who basically started placing bets on this in like well into last year, way before this, and so now Russia Ukraine is just kind of the bitter cherry on top of the cake. All right. So could you introduce us to your concept of the liquidity cycle? Because I've seen, and I don't know if I had a problem sharing my screen, but if you can try to share that slide.
Share mine.
Yeah.
And see if we get there. How's that?
Oh, looks like you're doing fine. All right. So yeah, can you introduce this concept and then show us, like, walk us through in a little bit more detail what was leading us into COVID and what's happened since then, and what can we expect going forward?
Okay, well, let me say up front that this, I think you've got to distinguish or separate out this particular cycle, which is a monetary cycle, from the events of Russia-Ukraine, which is hopefully a one-off supply side shock. But clearly the two are coming together and creating quite a lot of chaos right now. Now, what you're seeing on the slide is a black line, which is actual data, which is data we compile from around 80 to 90 central banks and financial systems worldwide, which is an index of the liquidity creation or liquidity impulse that goes through economies, the world economy, over time. And that index is basically averages an index of 50. It ranges between 0 and 100. It's a statistically normalized series, so it's got fairly standard amplitude. And the dotted line that we put on top of that is essentially an eyeball estimate of what the best fit sine wave would be that effectively sits on top of that. And the idea of the sine wave is that it's sort of a recurring regular cycle. As it happens, it's just over 5 years long, about 5.5 years long. And what it's purporting to show is that this liquidity cycle has its own tempo, which is a very regular tempo. Now, that tempo may be in the gift of central banks to some extent, but it's a fairly regular cycle. And it's a cycle that's important in terms of understanding what happens both in economies and more generally in asset markets. And what you can see latterly around about 2019, just coming into 2020, was that the liquidity cycle was basically very low. And that was suggesting that actually the economy was already starting to feel some headwinds, negative headwinds, and asset markets were generally finding it difficult to make progress. And then we got the COVID emergency, and what you see is a near vertical increase in that liquidity stimulus. This, in the case, is the US only data, but believe me, the global one looks, very similar, similarly dramatic. And what you've basically seen is a near vertical climb in that liquidity impulse that has caused financial markets in general to charge higher. So stock markets have gone up a lot. House price inflation is now rampant in many economies. And we've already seen an inflection downwards in this cycle, largely as the Federal Reserve itself begins to tighten, but actually also because inflation is picking up. And so as inflation picks up, it eats into the into the amount of liquidity, the real or effective spending power of that liquidity. So what you're seeing is the liquidity cycle inflecting downwards. Now, if it's true to form, and I think you can judge that relative to what happened in the COVID crisis. COVID crisis didn't really alter the cycle. It may have displaced it slightly by about 12 months, and it may well have increased the amplitude above what you would normally expect. But otherwise, the cycle is more or less intact. And if you extrapolate that black line downwards, what you're looking at is a low point in the cycle coming somewhere around about mid to late 2023. So in other words, we've got a lot of headwind in front of us, and that headwind is going to be encouraged, fostered, or even created by the Federal Reserve basically tightening policy. And Fed governors are almost trying to leapfrog each other now by sort of telling us that the tightening is coming. The tightening is coming. Watch out. Brace for this tightening. So that's the issue. Now, what does it mean? Well, what it means is that you get a response in asset markets. And what I've done, again, maybe this is a slightly wonkish chart, but what it's showing is the growth rate here of global liquidity as a percentage change, which is the orange line. And the black line is basically the increases in world wealth each year in black. Now, that both are time series, but what you can see is that the correlation is actually pretty good. In the period up to 2010, the correlation averaged about 0.57 between the two data series. But since 2010, it's jumped quite significantly to about 0.84. Now, that's a very high degree of positive correlation. And what we've done is we've extrapolated the orange line forward to the end of 2022 to show that the growth rate really continues to come down. And if you look at the black line, which comprises, as the label says, it's all wealth. It includes financial assets, stock markets, bond markets, basically money market funds, cash holdings, gold. Actually, it also includes cryptocurrencies I'd throw in, plus the housing stock. Housing stock for most people is their dominant form of wealth. And if you look at it on average within this data, housing is probably about half of that data series. So, what this is pointing to is some cooling generally in asset markets and probably absolute falls in a number of cases. So that's really the bigger picture. Now, to make this more granular and maybe to bring it home, this chart is looking specifically at the S&P 500, so Wall Street, the broadest measure of Wall Street, or the most identifiable measure of Wall Street, which is the S&P index, which is drawn there in orange. And the red line is looking at the monetary injections by the Federal Reserve. Both of those two series are drawn at a weekly frequency. And you can see the very tight correlation between the two data series. And it's our view, we may be proved wrong, of course, it's our view that red line, which is Federal Reserve injections into the system, are basically heading downwards as the Federal Reserve shrinks its balance sheet. And what we're really trying to emphasize in this is that the really important dimension in terms of understanding central bank activity is not really the rate of interest, in other words, Fed funds rate, it's really the size of their balance sheet. That's really the critical element. And it's the critical element in many ways because the financial system that we know and love is not really a new financing system anymore. It's a refinancing system because there is so much debt sitting out there in the world, some $300 trillion of debt with an average life or maturity of about 5 years, which means that you've got to refinance a whopping $60 trillion of debt every year just to stand still, right? Even without any new debt coming on board, which of course it is all the time. And that means you need balance sheet capacity to roll that debt over. And balance sheet capacity is liquidity. And the liquidity source, the ultimate source, is the central banks or the central banks, and the Federal Reserve being the main one of those. So if the Federal Reserve is starting to shrink its balance sheet, you're starting to see bigger and bigger financial tensions. And if those financial tensions escalate, you'll start to see financial institutions and investors coming out of riskier assets like equities and moving more into the safety of government bonds, particularly at the shorter end of the market. So in other words, short-term government debt. And that's almost exactly what's going on right now.
I have a few questions on this. So first of all, these last two slides are basically the price of those assets, right? So we're not necessarily getting wealthier because of the money supply, but it's just that the price of crypto, the price of gold, the price of housing, the price of the S&P are all higher. And so indirectly that there might be, living standards might be better, but it's not necessarily the case that living standards of everyone are always better when the price of everything is higher, right?
So, well, I think yes. I mean, one is that these are not realized gains, of course. These are if I say phantom gains. I mean, basically, it's people's balance sheets or wealth levels that are going up, and clearly, what goes up can come down. So it's not money. It's not essentially cash in hand, but it's an asset. And I think the second thing is that this is highly skewed in terms of distribution, wealth distribution, into the sort of the top few percentages of the population. And that's true whether you're talking of the US or Europe or Japan or China. I mean, this is the reality. So the average Joe in the street is not really going to be a major beneficiary of this directly. Their pension funds may gain, their 401k plans may go up, but at the end of the day, the vast majority of people are not really participating in this wealth creation.
Right. So the person with no retirement account who's paycheck to paycheck buying more expensive food is kind of losing out.
That. Yeah. Absolutely right.
So could you go back to the first slide? I had a few questions on that. So these when the slope goes down, is that a reduction in liquidity from the market, or is it just a reduction in the rate of creation when the slope goes down?
In actual fact, it's the way that it's drawn. It's actually drawn from growth rates. The very fact that you're right. It's drawn on growth rates. If you go right down to the bottom, you'll probably see negative growth. But at the end of the day, what really matters, certainly for markets, is, if you like, the tempo, or if you like, the momentum in the cycle. So if I'm sort of explaining myself correctly, if you've got essentially liquidity expanding at 5%, they're going to get used to that 5%. And what markets respond to are the shocks either side of that. So if you get a shock up to 10, the market will suddenly jump. And if you get a shock down to 1% growth, the market will start to retreat. So it's shocks around the average which really matter in terms of financial market movements.
Got it. I asked
gains.
Got it. I asked because if you look at like the money supply just goes up. It doesn't cycle up and down like that. But this is the rate of liquidity.
Yeah, the rate of increase.
So the other thing is, if over by the COVID crisis, it looks like the liquidity bottoms out at 2019. Is that bottoming? Is it going up in? I guess, is this just like each year by point, or is it continuous? Because it looks like it starts going up before the COVID crisis, but is that bottoming out like just for the year, and so in 2020 it goes up?
Yeah, I mean, basically there was already an inflection point that was in place around the time of the COVID emergency. But what happened was that central banks really came in and pumped huge amounts of money back into the system. Now, it may well have been the case that they were leaning anyway towards easing, but they effectively just pumped huge amounts of cash regardless of that. So there was an emergency response.
Right.
But you would expect it anyway, some response, given the nature of the cycle.
Right. I guess my question is, was the liquidity already increasing before the COVID response?
It was, but nothing like the magnitude that we saw. So in other words, a little bit of an inflection. It may have got on that scale from wherever we were down at sort of around 15 on that index to maybe up to possibly possibly 25, 30. So there was the beginnings of an increase, but it was nothing like the response we got.
I see. So I have I think from what we said before, I think that clearly the direct handouts to people, especially in the context of supply constraints of food, are increasing the price of food. But what about the effect of these asset markets? Because clearly the financial markets don't just include the S&P, they also include commodities and agricultural commodities. Those are traded on the market. And it seems like a lot of this money early in the crisis went into the tech stocks, but there's been a rotation out of them and into commodities, perhaps because the commodities do have supply constraints, but then people are expecting their price to go up because of them, and then they come in and amplify that. Would you say that there's also, now I don't know if that's increasing the current price of food, but certainly if agricultural commodities are scarce and expensive right now, then the food that's grown this year that is then sold at the end of the year and into next year is going to be much more expensive. So do you think there's also another layer on top of whatever is going into the consumer's hands and whatever's restricting the supply of this liquidity that pumped up the S&P via the tech stocks and is now rotating into commodities?
I think there's that what you're saying is partly true, because that was anyway happening. Okay, the answer, the true answer is slightly more complex, but you're broadly correct. One of the things that you find, and this is again sort of sounding a slightly wonkish idea, one of the things that happens when you get liquidity coming into a system, people tend to take greater risks. Okay. And one of the concepts in finance that, as I say, it's going to sound wonkish, but one of the concepts people have is duration, which is, if you like, a concept is akin to time horizon. And generally speaking, if there's lots of cash around, people will look further out in terms of their willingness to invest in projects. If there's less money, they want an immediate return. Okay, so they tend to look at very short-term investments. So with lots of liquidity, investors were very prepared to invest in what are called long duration investments. In other words, long gestation investments, put it another way. And things like technology is the absolute prime example of that. And if you go back to year 2000, the millennium period, where Y2K saw this huge expansion in US technology, a previous boom, that was also associated with lots of liquidity that was coming into the system. And you can see around year 2000, there's another spike in liquidity on the chart. Now, that caused NASDAQ in America to basically soar and hit what were then all-time highs, and then subsequently collapse again when the liquidity came out. So what we're looking at in tech stocks, the seesaw movement, the huge increase and now the collapse, is actually, in many ways, a liquidity phenomenon. It's what you'd expect. And there's a parallel. Look at the bond market. The bond market, bond yields, US Treasury yields are rising now. They were rising through 2001, and that was triggering a collapse in those same tech stocks. And it's a very similar phenomenon. When you have very low interest rates, low bond yields, technology tends to do well because it's a long duration investment. Now that's a complicated answer, but it's what's going on. The food angle or the commodity angle is another dimension in that. And you are seeing essentially money spilling out, but it starts in the financial sector of the economy, and then it spills into the real economy. And as it spills into the real economy, production gets going, commodity prices start to pick up. And as commodity prices pick up, so you get the effects that we traced through before of maybe oil goes up, base metals go up, et cetera, and that's the normal pattern of this transmission. So it's the liquidity cycle certainly explains that. The other thing, which I said lends this to a slightly more complicated explanation, is that if you look at the roles of different international central banks, the Federal Reserve generally is the dominant central bank for the financial markets. Okay, it really controls the tempo not just of Wall Street, but of most international asset markets worldwide. People's Bank of China, which in size is not dissimilar to the Federal Reserve in terms of its balance sheet capacity, etc., tends to control not so much asset markets, but much more the tempo of the real economy. So if you see the Chinese starting to expand their liquidity or their money, you'll see an almost immediate response in commodity prices generally. Now, the interesting caveat to draw or point to ponder on is that China hasn't really been doing this in the last 18 months. China's actually changed its economic model away from sort of growth at all costs to much more one of emphasizing stability. And what they've done is effectively flatlined their monetary aggregates, or certainly their central bank balance sheet. They haven't been sort of goosing their economy in the way that they traditionally do. So had they joined this party, you'd have been looking at even greater gains in commodity markets. So what I'm saying is that part of the normal procedure hasn't happened. Mm-hmm. If it did, we'd be seeing a much greater disruption than we're seeing now.
In my last interview, I had on Josh Young, who is an oil and gas trader, and he described kind of the oil cycle. And I'd like to get your thoughts on whether this is like a liquidity cycle, commodity cycle interaction. He basically described it as what happened with oil was there was a credit boom, and that led people to use up a lot of stuff. And as they're building stuff, the price of oil and other commodities goes up. But this credit boom also led to lots of people investing in increasing the supply of oil, and did so, sort of overinvestment in increasing supply that then led the price of oil to crash. And then the liquidity started drying up, and then the oil from those wells started drying up, and now the price of oil is going back again. Of course, COVID got juxtaposed on top of that cycle. But is that a general description of a liquidity commodity cycle interaction where credit boom makes you use commodities, price goes up, but then you build stuff that increases the store of commodities that you need, driving price down, and then rinse and repeat?
Yeah, I think broadly that's correct. I mean, what you're saying is the best cure for higher prices is higher prices, and that's the way that commodity cycles work. I mean, the added twist in a lot of these things is where you get a more vicious response, often in terms of liquidity, is that one of the things that you see is that commodities are used as collateral for credit. So if oil is going up, you can, and you're an oil producer, or you hold oil inventory, you can borrow more from banks or credit providers on the basis of the value of your inventory or production is going up. But clearly, as soon as the prices start to go down, your loans might get called in, or you have to supply more margin to the lender because you've got higher leverage to support, or whatever it may be, and the whole thing then starts to collapse. So what you can see is very vicious cycles as a result of this interaction. So I'd say absolutely spot on, really, with that answer.
Interesting. So is it the price? So I guess is it owning the price of oil is high right now, right? But the supply is in deficit. So does that increase or decrease liquidity? Is it that there's a deficit of oil, therefore, even though it's expensive, no one owns extra of it to use it as collateral? Or is the high price actually improving liquidity?
Well, the answer is that probably the high price, or let's say to be more accurate, the volatility in the price is probably killing liquidity in a number of ways. I think you can look at this in different dimensions. I mean, one thing is to say that essentially, if oil prices go up, a lot of corporations get their margins squeezed by dint of the fact that costs are going up and it's difficult to pass those prices on. Their profitability is reduced, therefore their cash flow is reduced. And if you look at a lot of US corporations, they are holding fairly sizable amounts of cash in their treasuries. Okay, in other words, the profits they're generating are not only going for share buybacks or dividends. Capital investment is very reduced. That is building up large stockpiles of liquidity, which get invested in financial markets. Now, if they're not creating those profits, that liquidity gets destroyed or eroded over time. So that's a detraction from liquidity. Another factor is that if you get a lot of volatility in prices in the markets, in commodity prices, lenders, because of that increased volatility, will start to increase their margin requirements. In other words, how much cash you've got to put up, as well as the collateral. And that will discourage investors or those borrowers from taking out collateralized loans, and therefore the credit supply will drop. So generally, a high and volatile price of commodities is actually very negative for liquidity.
And so is that the type of thing that's actually going on at the end of your chart? Because my understanding, and correct me if I'm wrong on this, my understanding is that the Fed has been slowing the growth of the balance sheet and is expected to reverse the balance sheet, but isn't actually sucking assets out, right? Or am I wrong on that?
Well, the answer is there in red and white, so to speak, which is the data doesn't lie. This is as of last Wednesday, so it's very up to date data. So we're talking about the last week of March 2022, and the last data point on that red line is what the Federal Reserve's been doing. Now the balance sheet. I mean, I'm not going to get into the entrails or into the weeds of the balance sheet, the Fed balance sheet, because there's lots of moving parts. But let's call this red line the effective balance sheet, because there are lots of other things they do, which smoke and mirrors means that what the balance sheet per se is telling you is not always the effective impact it has. And there are other factors that go on, which I can go into if you like, but I think that's slightly wonkish. But take it from me that the effective amount of money that the Federal Reserve is injecting into the system is shown by that red line. And that has come down by, as you can see very roughly from the data, it's fallen by about $500 billion since late 2021.
All right. And so going forward, if you expect liquidity to keep dropping, what does that offer any? Would you expect it to offer any reprieve to these high food prices, or would you think that we are just so constrained by supply problems that, I mean, would it mitigate the expected rise in food prices, or would it make it worse just by hampering our ability to dig ourselves out of the supply problems?
Well, I think the first thing to say is that if you look at that graph and you listen to what the Federal Reserve and some Fed officials are hinting, they are suggesting that red line will come down to somewhere in the region of the 4.5 trillion, so 4,500 billion level, something of that magnitude. Some are talking slightly more, some are talking less. I think that's an ambitious target, but they're talking about a sizable squeeze. Now, the only way that the Federal Reserve can really control inflation, generally, they can't. They have no effect on specific items by definition. But general inflation, they can kill by basically breaking the system. So they have to smash the economy. And that means, taking growth right down and probably creating a recession. And on all the data that we look at, and that's embellished as well by things like consumer surveys. All the indications are the US economy is getting very close to recession. Okay. And although the administration won't want to admit that, that's probably the path that we're heading for. Now, and by the way, that's not just a US phenomenon, that's more generally global. So I think point number one is that we're heading for some sort of squeeze. Your question is, will that solve the problem? Well, it will solve the problem to some extent, but it won't solve the problem overall. And the reason for that is that the Federal Reserve can only, or monetary authorities, policymakers in general, can only affect the general price level, and that's by killing demand. So what they're doing is they're creating, or they're destroying demand and trying to create some excess supply environment whereby prices will come down in general. And that will filter through by wages being depressed, by other prices coming off, and then that ultimately coming through and feeding back into food prices in some sense. Now, as you can see where I'm going with this, good luck on that theory, because it's a long time. And the point that, we tried to make in our research is that, we're in a very strange environment where the Federal Reserve initially didn't want to tighten policy. They were very reluctant to tighten policy. In sort of economic or finance speak, they are behind the curve on inflation. But they may have deliberately been so because they didn't want to rock the boat coming out of COVID. And the very use of the word transitory by Chair Howell last year was indicative to me, or to many people in finance, that the Federal Reserve didn't want to tighten. Well, otherwise, why use the word transitory? It's almost telling the markets that you don't want to tighten. Now what they're doing is they're doing the reverse of that. So they're being basically very aggressive, trying to be very aggressive in terms of what they're doing. Now, if we then get back to the reality of today, price shocks in the economy 2 years ago, on average, lasted about 2 to 3 months in the price structure. Okay, so in other words, whatever the shock was, it would have a very short duration in terms of influencing prices. It washed out fast. Today, the evidence we've got from recent history is that price increases are persistent. So any price shock is lasting now about 2 to 2.5 years, right? So in other words, what that's basically saying is, in sort of, to put it arithmetically, something like if you got a 1% shock in inflation in March, that will pass through to a 70 basis point or 0.7% shock in April and a 0.5% shock in May, etc. And that tail will be persistent. It will last through about 2.5 years before it effectively disappears. Now, that's quite a long period. So what we're looking at is a rather sustained or persistent inflation. Now you come back to the specifics of the food industry and maybe commodities, and you come back to the reality of Russia, Ukraine. In many ways, from a food point of view, I don't think this conflict could have hit in a worse place, because these two countries are very integrated in the energy and the grain business and the fertilizer business, but by association. And that has a lot of implications worldwide. Okay, Brazil takes a lot of fertilizer from Russia, Ukraine. The Middle East takes a lot of grain from via Odessa into those countries. Ukraine is a major grain exporter there. We know that energy goes into Europe en masse from Russia. So all these things are basically starting to feed through. One of the other implications is that in terms of slaughtering animals for meat production, right? One of the things that you need, particularly for poultry, is gas to gas them. Where does that gas come from? You've guessed it, to Ukraine. So what you're finding is that there are shortages in many, many areas. And the world has to find new sources for these inputs. And that's going to be expensive and time consuming. So I think we have a problem.
Yeah. So would it be fair to say that if all we were seeing was just the liquidity cycle and the commodity cycle interacting, then maybe we would be looking at a 2.5 year thing. But because these supply constraints are not being solved, we have to layer in whatever unknown amount of time plus at least one growing season for that to, the solution of that to cycle through food production to actually see an end to the rising food prices. Is that?
I think exactly correct. Yeah.
And it doesn't.
It's very difficult to predict.
And the future doesn't look bright for predicting a time when that will turn around, right?
I don't think so. I mean, basically, unless Russia, Ukraine are brought back quickly integrated back into the world economy. But, I think we're all of a mind to say that just is not going to happen quickly.
Yeah, and I guess let's say that happens tomorrow. We know it won't, but even if it happened tomorrow, we'd still be looking at a few years, right? Because we have, first of all the commodity prices for this growing season are being set now, and
correct.
And
crops would be planted; they're not being planted.
Yeah, I have one side question, and then I'll give you, we can wrap up. What do you think? My impression here is that I'm wondering how the sort of middle class retail investor or the 25-year-old who spent their stimulus check in their Robinhood account. I'm thinking about them for a moment. It seems like all this liquidity blew up the tech stocks, and so you had everyone who jumped in on that. I kind of doubt that retail investors, or at least people who were newbies and just jumped in when they saw tech stocks going through the roof. I kind of doubt they jumped into the commodity trade early, and so it seems that in a general scale, the cycle just goes on. But it seems like there's probably a lot of people to feel sorry for who, don't realize that their tech stocks are just dropping and the commodity prices are rising, and they lost a lot of the money that on paper they made, and now they have to buy expensive food. That it seems like that's probably a real dynamic. Would you say?
I think that's probably absolutely right. Yeah, but it's you got to remember these are highly volatile markets that you're talking about. And I think it was, I'm going to get the quote wrong, but wasn't it Mark Twain who said that January is a very bad month to speculate in stocks? The others are February, March, April, May, June, etc. And that's always true. I think you've got to take a view about investment. And I think the point, the lesson of sort of being in the financial business for a long time is that in the asset markets for a long time, the one thing that basically keeps its value over the very long term is real estate. That's the shining lesson of all these things. It's the best inflation hedge. We got inflation coming back, and I must say I'm not convinced we have in the long term, because I think there are lots of mitigating factors. But I could be wrong. But in the case I'm wrong, real estate is a fantastic long term investment. Now, okay, we're seeing a surge in prices now. It will come back as the Fed hikes rates more. Mortgage rates are already up, 100 basis points in the US already. It's going to probably go more. But, this is the time to start thinking about, going into that area.
Mm.
Also, I think that you've got to start thinking outside of the box about things like food and about maybe investing in companies that have the ability to, secure and produce food in the longer term, because this is a commodity which will be as open to disruption as we've seen, and it's clearly integral to everybody. And I think the third thing, which is maybe a sort of, again, a maybe out of the box thought, but it sort of fits into the tech space. I still think cryptocurrency is an extremely interesting long-term investment area. And okay, hey, it's a volatile asset class, but most asset classes are volatile in the early days. But I think in the long term, the world is changing. And one of the lessons that we've learned over this period, I think, is that cryptocurrencies are actually not a bad store of value in this environment. They've remained liquid. Exchanges have remained open. They're not constrained in the same way as foreign exchanges. And hang it, if Russia had all its reserves in cryptocurrencies, it would be in a much different position than it's in now.
Yeah, that'll be very interesting to see how that works out. All right, so just in general, we're looking at, I guess, 2.5 years at least, probably more, of high food prices. Do you think food prices are going to keep going up or accelerate, or do you just think they're going to remain elevated for that time?
I think we're going to see faster food price inflation, over the next 6 to 12 months. I think for sure, but I think food prices will remain elevated. But I think to a very large extent because what we got to remember here is that Russia, Ukraine, and many other countries were brought into the world economy. The globalization thing brought these countries in. They were cheaper places to produce, but now they're off the map. So we've got to find new sources of cheap production, and they're not readily available. It's going to take some time to create that. That's the reality. Changing supply sources, supply patterns takes years, if not decades, to occur.
So then, if we have the space, we should buy 2.5 to 10 years worth of food. Would be a good investment.
It could be, yeah. But we live in a volatile world now. Yeah. I'll give a plug to, if I can.
Yeah, go ahead.
On my share screen, is that this was a book I wrote 2 years or so ago, which is basically about liquidity and how important it is. And basically the sort of theme of it is as the world gets bigger, it becomes more volatile. And that's what we've seen, over the last 20, 30, 40 years. Basically, this is the reality. And a lot of it is about liquidity. And the final chapter is basically looking at focusing on what I call capital wars, basically between China and the US, and how this thing evolves in the future. But this is the uncertainty we're basically living in. But it's sort of interesting times. And if people want to follow what we do, we're a research organization that supplies clients with research, but we have a Twitter account which the handle is @CrossBorder Cap, and people can sort of see insights there from time to time.
Awesome. Thank you so much, Dr. Howell. It's been great to have you. And thank you for generously spending your evening. I know it's late over in the UK, so thank you so much for being here. This was extremely educational, and I greatly appreciate it. Thank you so much.
Good. Thanks so much, Chris. Thank you.